Welcome students. I am Dr. S. Manikandan, Assistant Professor of Economics, Erode Arts and Science College, Erode. Today I want to discuss with you introduction of public finance. What is public finance? Public finance is one of the old branches of economics which highlights the role and functions of the government in economy. In other words, public finance is the management of a country's revenue, expenditure and debt of the government. The subject matter of public finance are public expenditure, public revenue, public debt, financial administration and federal finance. The term public expenditure are included the following contents. The public expenditure is spending made by the government of a country on collective needs and wants such as pension, provisions. These are all includes education, healthcare and housing also, security, infrastructure, etc. We can say also, in other words, public expenditure is the expenditure incurred by the public authorities to satisfy those common wants which the people in their individual capacity are unable to satisfy efficiently. The public expenditure is the major role for public finance. So recent days public expenditure growth rapidly. So the following reasons are increase the public expenditure. First one is defense expenditure, second one is population growth, third one is welfare activities, fourth one is war and social crisis, fifth one is creation of supranational organization, and last one is foreign aid. Defense expenditure due to the modernization of defense equipment by the Navy, Army and Air Force to prepare the country for war or for prevention causes for the growth of public expenditure. Then second one is population growth. Population growth is increase with the more is required to be done by on law and order. Then third one is welfare activities. Welfare activities means midday meals, pension provisions, like that. Provision of public and utility services, accelerating economic growth, price rise, increasing in public revenue. So these are all the aspects are also included the welfare activities. Fourth, wars and social crisis, creation of supranational organization and foreign aid is also causes for increasing public growth. Definition of the term public expenditure. The expenditure incurred by public authorities like central, state and local governments to satisfy the collective social wants of the people is known as public expenditure. Public revenue is the second important concept of public expenditure. The public revenue means the income of the government through all sources is called public income or public revenue. The definition of public revenue is public income has two senses, wide and narrow. In its wider sense, it includes all the incomes or receipts which a public authority may secure during any period of time. In its narrow sense, however, it includes only those sources of income of public authority which are ordinarily known as revenue resources. To avoid ambiguity, thus the former is termed public receipts and the latter public revenue. Sources of public revenue. We have 7 sources of public revenue. They are taxes, fees, fines and penalties, special assessments, price, gift and donations, and grants in aid. The first sources of public revenue is tax. Taxes are compulsory contribution imposed by the government on its citizens to meet general expenses incurred for the common good without any corresponding benefits to the taxpayer. The second one is fees. Fees are charged by the government or public authorities for rendering a service to the beneficiaries. To quote Seligman, a fee is a payment to defray the cost of each recurring services undertaken by the government primarily in the public interest but confirming a measurable advantage to the payer. Then third one is fine and penalties. Fine and penalties is a sum of money exacted as a penalty by a court of law or other authority. Penalty is a punishment imposed for breaking a law, rule or contract. Then fourth one is special assessment, a special tax levied on private property to meet the cost of public improvements that enhance the value of the property. And next one, gift and donations. Gift and donations are government can only claim a tax deductions for a gift or donations to organizations that have the status of deductible gift receipts. And last one, grants in aid. The grants in aid is money coming from a central government for a specific project. Such funding is usually used when the government and the legislature decide that the recipient should be publicly funded but operate with reasonable independence from the state. So these are all the sources of the public revenue. Classification of public revenue. Public revenue are classified into 3 types: gratuitous revenue, contractual revenue, and compulsory revenue. Gratuitous revenue comprises all revenues such as gifts, donations, and grants received by the public authorities free of cost. They are entirely of a voluntary nature. Further, these are very insignificant in the total revenue. The second one is contractual revenue. The contractual revenue includes all those types of revenue which arise from the contractual relations between the public authority and the people. Fees and prices fall into this category. A direct quid pro quo is usually present in these types of revenues. And finally, compulsory revenue. The compulsory revenue includes income derived by the state from administration, justice and taxation also. Taxes, fines and special assessments are regarded as compulsory revenue. These revenues express an element of state sovereignty. It is the most significant type of public revenue. The third factor for public finance is public debt. Public debt means the modern governments need to borrow from different sources when current revenue falls short of public expenditures. Thus, Public debt refers to loans incurred by the government to finance its activities when other sources of public income fall to meet the requirements. Public debt is the one of the major content for public finance. Public debt is classified into three types: internal and external debt. Second one is productive and unproductive debt. And the third one is short-term and long-term debt. The internal and external debt is raised from within the country, and external debt is owed to foreigners or foreign governments or institutions. The second one is productive and unproductive debt is productive debt is expected to create assets which will yield income sufficient to pay the principal and interest on the loan. In other words, they are expected to pay their way, they are self-liquidating. It is the productive and unproductive expenses. Third one is short-term and long-term loan. The short-term loans are repayable after short interval time. For example, treasury bills payable after 3 months. Ways and means advanced from the central bank. They are intended to bridge gap temporarily between current revenue and current expenditure. It's called floating debt. Long-term loans are payable after a long time covering several years. They are called funded debt. Causes of increase in public debt. We have 5 causes for increasing public debt. The first one is war preparedness. Second one is frequent budget deficits. Third one, undertaking of welfare schemes. Fourth one, public utilities. And last one, urge for economic growth. The first one is the most important cause of increasing in public debt is war and war preparations. Recent days, nations attach a great importance to their territorial integrity, and they consider no sacrifice too much to defend their country. The second one is frequent budget deficits. The frequent budget deficits is also due to fairly frequent budget deficits or current account. These deficits arises from the necessity of maintaining full economic activity in the economics, which may have ceased to expand. Then third one, undertaking welfare schemes. The undertaking welfare schemes is increasing, one of the reasons for increasing public debt, because it's also due to the undertaking of welfare schemes by every government in modern times. And fourth one is public utilities. Where there is no convenient profit check, no right control over cost can be maintained, at there are more losses than gains. So they also add to the weight of the public debt. And finally, the economic growth. In recent years, urge for economic growth has induced the underdeveloped countries to contract debts both internally and externally. The volume of public debt has consequently swollen. The fourth factor of public finance is financial administration. The financial administration is the fuel for the engine of public administration. Sir Lloyd George is reported to have once remarked that government is finance. This quote correct because almost everything the government does requires money. This is a small definition of financial administration. According to Kautilya, all undertakings depend upon finance. Hence, foremost attention shall be paid to the treasury. The operation agencies of financial administrations are the executive, the legislature, the finance ministry, and the audit, which sits in judgment. The financial administration consists of those operations, the object of which is to make funds available for the governmental activities and to ensure the lawful and efficient use of these funds. These operations are performed by the above agencies. The executive which need funds, and the legislature which alone can grant funds, and finance ministry which control the expenditure, and finally the audit which sits in judgment over the way in which the funds have been spent. These are all the major financial operation agencies in financial administration. The major divisions of financial administration is preparation of the budget, legislation of the budget, execution of the budget, treasury management, and rendering the accounts. The preparation of the budget is estimate the revenue and expenditure for the ensuring the financial year, and second one is getting these estimates passed by the legislature called legislation of the budget. Then third one, execution of the budget is regulation of the expenditure and raising of revenue according to it. And fourth one, treasury management is safe custody of the funds raised and due arrangements for the necessary payments to meet the liabilities. And finally, rendering the accounts means by the executive and the audit of these accounts. Federal finance is the last part of public finance. Federal finance refers to the system of assigning the course of revenue to the central as well as state governments for the efficient discharge of their respective functions. Federation means the union of two or more states. It can be defined as a form of political association in which two or more states constitutes a political unity with a common government, but in which these member states retain a measure of internal autonomy. In our constitution, there is a clear division of powers so that none violates its limits and tries to encourage upon the functions of the other and functions within own sphere of responsibilities. Division of powers. Our constitution gave a clear-cut idea about the division of powers. There are three lists enumerated in the 7th schedule of our constitution. They are the union list, the state list, and the concurrent list. The union list consists of 100 subjects of national importance such as defense, railways, post and telegraph, etc. The state list also included in 61 subjects. It's like local interests such as public health, police, etc. Then finally, concurrent list is also included, has 56 subjects important to both the union and the state, such as electricity, trade union, economic and social planning also. Principles of federal finance. Independence and responsibility is the first one. Second one, adequacy and elasticity. Third one, administrative economy and efficiency. Fourth one, principle of equity. Fifth one, principle of integration and coordination. Sixth one, principles of accountability. And last one, a principle of uniformity. The first one is independence and responsibilities, means that central and state government should be financially independent within their own sphere, and each government should take the responsibility of taxing, spending, borrowing, and raising resources in their space for performing their functions. The second one, adequacy and elasticity. The principle of adequacy means that the resources of central and state government should be adequate so that each layer of government can discharge its obligations laid upon it. Administrative economy and efficiency. Administrative cost should be minimum and there should be no frauds and evasion in matter of finance. Corruption and integrational smuggling are to be avoided. The principle of equity is there should be proper adjustment between federal taxation so as to make the tax burden on all citizens equitable as far. Principle of integration and coordination is integration of financial system is an essential in contemporary federations. This should be done in a way that promotes economic development. Coordination is also important for smooth, efficient working of federal financial system. The principles of accountability is also a very important one for in federal finance. Freedom and democracy are very essential for any financial system. Therefore, in federal system, such government should be accountable to its own legislature for its having and spending decisions. And finally, principle of uniformity is also very important one, because each regional government provides an adequate level of public service without resort to higher rates of taxation sustainability than those of other regions. Functions of federal finance. Distribution of net proceeds of taxes between center and the states to be divided as per their respective contributions to the taxes. Determine the factors governing grants in aid to the states and the magnitude of the same. To make the recommendations to President as to the measures needed to augment the consolidated fund of a state to supplement the resources of the panchayats and municipalities in the state on the basis of the recommendations made by the Finance Commission of the state. Center-state financial relations. A main departure in the financial provision of the Constitution from the scheme of the Government of India Act 1935 consists in the institution of a Finance Commission under Article 280. Finance Commissions of India. Finance Commissions of India act as a major role for conflict between the center and state financial relationship. So far, we have formulated 15th Finance Commissions. The first Finance Commissions was formulated in the year 1952 under the chairmanship of K.C. Yogi. And finally, 15th Finance Commission was formulated in the year 2021 under the chairmanship of N.K. Singh. Thank you.